Hey guys, welcome back to my channel once again. And today we are on the part 2 of stock market 2022 scenario video. Is it going to crash or whatever? So the main things what we covered in part 1, based on those analysis, I have made a different strategy for my personal investment. Yeah, and I already gave you guys a hint in my first part of this video, but now let's go on to few of the examples and I will show you what kind of investments I am now interested in and what I'm doing. Just few examples, yeah, otherwise this video will again become too long. And I will share with you guys the amount of my portfolios and how much I'm down, just to be transparent. And one portfolio which is doing quite good because of the same strategy which I am using right now to survive in this current economy. So let's get started. Okay guys, so here we are, and this is the very first example which I would like to cover with you guys, which I have been also discussing in my Patreon's community. The first example here and the first business which I would like to talk about is Activision Blizzard. Now this company is into video game industry, and let's go on and check some of the key ratios. Of course, I'm not diving in deeply into this particular company, and I'm not diving in into any of these companies which I'll be sharing here. These are just few examples out of my complete value investment portfolio and the portfolio which I have shared with my Patreons and the companies which I'm regularly sharing with my Patreons. But I'm just giving you guys an idea what is my strategy to make you understand, or which can help you understand what I am doing in such cases and such economic crisis, let's say. So first of all, let's have a look at the market cap, which is at $49 billion. And what attracts me is the PE ratio, which is sitting at 18.87. Now the industry PE ratio is somewhere around 19, which is still so Activision Blizzard is still lower than the average industry P ratio of this niche, and the forward P ratio is quite attractive for me, which is 16.59. So forward P ratio is the P ratio which is dependent on the projected earnings or the assumptions which by the analyst which is made, and those projected earnings for the next 12 months, and based on those projected earnings, the current market cap, how it is portraying the value of the business. So depending on the next 12 months projected earnings respect to the current market cap, we have this ratio 16.59. And like I said, the industry average P ratio is 19, so it's still undervalued in my opinion with respect to the forward projected earnings. The price to free cash flow is 17.74, and guys, trust me, for such a growth industry, such a price to free cash flow is really cheap. In my opinion, this could be 2025 easily, but it's trading at a lower price to free cash flow. Now some other things which I would like to show you guys. So let's jump onto the financials, and if we go on to the total revenue, we can see that the quarterly revenue is increasing nicely, and the yearly revenue, if we go all the way back to 1989, we can see the yearly revenue has been increasing. What this tells me? This tells me that this particular business is not lagging behind to acquire a really good chunk of the market in which this business is in. That means it is giving a high time to its competitors. Since we are talking about competitors, let's have a look at some of the competitors. So these are the best competitors in this niche, this industry for Activision Blizzard. And as you can see, Zynga, Epic Games, Electronic Arts, Nintendo, not Nintendo, okay, Take-Two Interactive, Platica. These are some of competitors for Activision Blizzard, and you can see Activision Blizzard has the highest revenue curve between all the competitors. Also net income, as you can see, Activision Blizzard is the only company whose net revenue is increasing since 2017. And you can see Electronic Arts had a pump but then fell down. This is not what I would like to see in a business. And then also we have Epic Games, sharp decline in its net income, and also the others are really lower than Activision Blizzard. So only Activision Blizzard is one of the businesses out of these businesses who has a steady incline in its revenue and net income. You see the curve seems really good. This also tells me that their margins could be really great. Yeah, so you can see I have made few comparisons with Activision Blizzard, Electronic Arts, and Nintendo. In that case also, Nintendo is pretty good competitor. Those, let's say, were competitors, but still Activision Blizzard's blows them all in valuation. Here we can see the free cash flow. Yeah, the free cash flow for Activision Blizzard has been increasing again. You see this curve? This is what is telling me that Activision Blizzard is doing pretty well. And if you see Nintendo's free cash flow was good, but now it is declining. What this tells me is that even in such scenario, Activision Blizzard is improving its margins. And if you see from 2019, and if we can go back, yeah, if we go back here, we can see that the free cash flow for Activision Blizzard has been improving. You see, okay, here it was consolidating, but this means that their margins were not becoming bad or worse. But in case Electronic Arts is now becoming lower, but Activision Blizzard on the other hand is improving. The only business who is improving and improving to generate a good free cash flow. That means they're improving on their margins. And if you are a regular viewer of my channel, then you should know that margins are one of the most important factors which I consider when I'm evaluating a business. And the better the margins get for a business, the better the business is becoming. So this is just some highlight which I wanted to show you guys for Activision Blizzard. And this is the first business which I'm really interested in because of many other reasons, but this is just a summary which I wanted to give you guys to help you understand my mindset for choosing a business. Okay guys, so the second business and the second stock which I would like to talk about is Discovery, and this is one of my favorite companies for now, and I have been accumulating this company quite heavily with all the dips, all the recent dips which it had. And I have also mentioned this company to my patrons, of course. So all of these companies have already mentioned to my patrons and many more based on my analysis. So of course, the business, the stock price is not doing that great because of the skepticism surrounding the spin-off of Discovery with Warner Bros. And people are really skeptic about the business because they are entering into this new niche and there is a lot of competition in online streaming. But I'm sure that this business is gonna do pretty great. Of course, they are accumulating some debt, but with this cash flow machine, they would definitely be able to cover this debt quite quickly. But anyways, if we don't look at the business, yeah, if we ignore all the skepticism, if we just look at the fundamentals for now, which I am doing in this video, then you would be amazed to see these fundamentals. So just have a look at the forward P ratio. Forward P ratio is just sitting at 8.8, guys. For any industry, doesn't matter, this P ratio is pretty cheap. And the trailing 12-month P ratio is just sitting at 12.12, which is also really cheap for any industry, regardless of the industry. And look at the price to free cash flow, 7.21. This is sick, guys. This is sick. And if we look into the financials and if we go on to the total revenue, we can see that their yearly revenue has been increasing. This is from 2011. If we go all the way back to 2003, you can see their revenue has been increasing. Only in 2020, of course, because of the spin-off, they had let's say not a rough year. I wouldn't say this is a rough year. There was a slight decline, but yeah, this is okay. It's a business, yeah. So this can happen. And if we now move on to the free cash flow, and if we go all the way back again to 2006, we can see, guys, they were generating a huge amount of cash, yeah, and they are in positive cash flow. So this is what I'm talking about. It doesn't matter if it was a slight decline, but they had to put some cash, first of all, for the dividends to still keep the investors in, and also for the spin-off. So I wouldn't say that this is a bad sign. No, the business had an acquisition, there was a spin-off, and this is bound to happen. Though 1 year or 2 years, if they have less cash flow, I wouldn't mind. I'm anyways holding this business and buying this business for long term, because after the spin-off, they would need some time to get into this new zone and to again gain the confidence of the investors. So I have no problems with this slight decline. Like I said, I'm choosing those businesses which have positive cash flow, and that's what matters to me for now. This business has a positive cash flow, and not just positive cash flow. This business is a cash generating cow. Yeah. So that's why choosing this business. So like I said, these are few of the reasons why I'm choosing this business. Undervalued, generating huge amount of free cash flow, good amount of free cash flow, positive earnings, and has been doing pretty great. revenue has been increasing, and yeah, all the 6 reasons why I have chosen this particular business. Again, this is not a detailed video. If you want to get a detailed analysis, let me know in the comment section down below. Then guys, the next business which I have my eyes on and which I have mentioned to my patrons as well, I have given my analysis to my patrons, but here I would just give you guys some of the reasons why I'm choosing this business as my value investment for the same reasons why I'm choosing the other businesses. Is first of all, this business had a hard hit. As you can see, the maximum it had gone is to $92, and now it's sitting at just $16. I mentioned this particular business to my patrons when it was at $15 or so we are up by a significant decent percentage. And as you can see, the price to free cash flow is sitting just at 11.55. Price to book value is quite decent, 1.96, and price to sales is sitting at 7.19. The price to earnings here is nothing, because in the last quarter they had a negative earnings. But if you look at the financials and if we click at the total revenue, we can see that the revenue has been increasing amazingly. You see, this is exponential rise. And then so if we go on to the Yahoo Finance, we can see they have been doing really pretty good. So you can see that their annual revenue has been increasing exponentially, and they generated positive earnings in 2018 when they had a negative earnings in 2017, and the earnings had been also increasing. So if you look onto the quarterly report, we can see that's the reason why we had no PE ratio, because the earnings in the last quarter was in negative, so the trailing 12-month PE ratio was 0. But if we look at the analyst projections and if we look at the statistics, we will see that the forward price to earnings ratio for this business is just 11.14. So let's go on to here and let's see the analyst projections. So this will show us that how this business is supposed to do in the future. I mean, just some projection. So we can see that the revenue is supposed to increase up to $24 billion, and the earnings per share is also supposed to increase. So we can see that this business in future is projected to generate amazing revenues and amazing earnings. So as we can see that we have the forecasted percentage change could be plus 426%, lowest on the lower side, and 464% on the higher side. Yeah, so for the revenue, so we can see that this business could do amazingly well. This is quite undervalued in my opinion. And if you see some analyst price targets, we can see that the highest is sitting at 551%, while the lowest is 75%. But I don't consider this for now because of the various reasons, because of these fundamentals which are supposed to increase in the future, and the analysts are projecting that these revenue estimates and EPS estimates will flourish in the future for the particular business. And also guys, this business has come in Berkshire Hathaway's attention. That means Warren Buffett's attention. By the way, this business has a similar concept like Shopify, and you can see that Shopify is sitting at a price to earnings ratio of 40, I guess, now, because they just turned in positive earnings this quarter, and we can see last quarter, and we can see the price to earnings is sitting at 42.40. So this is a US based company, of course, so we can see that people are much more confident about this business. And Stone Corporation is a North American based business, and that's why I think people are not so much confident about this business and their market. But I think that this is fairly undervalued based on their revenues estimates, based on their top line numbers. I do think that this business is fairly undervalued, and that's why I have considered this business into consideration as well for hedging my portfolio against inflation. Again, this is not just about hedging, but this strategy is just to pick up some value investment with strong fundamentals, which means that doesn't matter what type of economy we will be in, these businesses will flourish sooner or later. Here is one more example which I want to share with you guys. Brookfield Infrastructure Partners. This is one of my favorite businesses because of various reasons, and one of the reasons is because their contracts are also inflation hedged. So that means that if inflation rises by XYZ percentage, they can upgrade their business contracts by that same amount, by that same percentage of inflation, and thus passing on these costs back to their customers. So this is one of the businesses which are really amazing in my opinion. I'm not digging deeper into this business, but as you can see, these multiples in case of price to earnings ratio is sitting at 25, which is okay in my opinion considering this particular industry which this business is in. And if you can see these analyzed price targets, we can see that we have a minimum upside potential of 12%, and this is just for 2022. I think that this business is going to flourish in the coming years. So if we look at their financials, if we look at their revenue, we can see the yearly revenue, and if we go back to 2006, we can see that their revenue had been increasing really nicely, and also their quarterly revenue has been increasing amazingly. So I do think that this business is going to flourish in the coming years, and that's why this is also in my portfolio. And one more reason is that they also pay out a dividend of $2.04, which is an yield of 3.35% annually. So this is a cherry on the cake for me, and this is one of those businesses which I really like, and this is also in my portfolio. So guys, last but not the least, and I'm sure this business, this company doesn't require any kind of introduction, and that's Google Alphabet. Now, why I'm choosing this giant when I'm also invested in other ETFs or indexes? Yeah, because of one reason. First of all, this business is highly undervalued in my opinion. Yeah, even at this market cap, yes, because you have to see the market cap with respect to its fundamentals, and we are talking about fundamentals in this video. So this is undervalued. And of course, if you see all the ratios, forward P ratio 23.91, current P ratio is sitting at 25, which is acceptable for me. Yeah, and price to free cash flow is sitting at 27.7. Now, if we go on to this comparison, yeah, here I have taken all the other giants which are driving the S&P 500 like Microsoft, Netflix, Amazon, and FB. Now again, there cannot be a direct comparison of these businesses because they are all working in a different industry, in different niche. Yeah, but since we are talking about one giant who is driving the S&P 500 index, and if that giant business is undervalued, then why not to acquire that business? I don't understand, because first of all, if it has a market cap of $1 trillion, that for sure means that you don't have any liquidity issues, and that business is for sure not going anywhere. Yeah, why to acquire a $1 trillion business which is overvalued, and why not to acquire a business worth $1 trillion and which is undervalued? Yeah, so the reason is quite simple, guys. And if you can see here, I have compared the net income. Net income of Google is the highest, and it has crossed the net income of Microsoft. As you can see, this curve, the orange curve, has crossed the net income of this dark orange curve, whatever the other color is. And if we see the free cash flow of Alphabet is again higher than Microsoft. Yeah, so Amazon, Meta platforms, Netflix, they are no way near Google. And that's the reason, guys, why I'm choosing this particular giant as an undervalued investment for my future. So that's all, guys. That was the final example which I wanted to show you. And just before we move on to the portfolio performance, I would just like to clarify one important thing, really one important thing. These are not the only sole factors and ratios like you saw, price to earnings, price to book value, which I see to evaluate a business, okay? These are not the only sole ratios. Remember that. I check the full business, how the revenue is generated, I try to understand the business. If I can really understand the business, how that business is making money, then I do further evaluation, okay? These numbers are not the only things which any value investor would check, okay? Yes, these ratios are helpful to dig deeper. If these ratios are really sick, if they are really crazy, higher in number, then no investor would even want to look or go into depth, a value investor, yeah? So these are helpful to, yes, make the basic understanding, make a base, but then you have to really understand the business and then do, for example, discounted cash flow and evaluate a business with other factors involved, with whatever method you want to use, and calculate the intrinsic value of the business, and not just the intrinsic value but also in which niche that business is doing, how is the competition, and many other factors. Okay, so it takes a lot to evaluate a business. These were just few factors which I showed you guys, and like I said, if I would go on in details, then that would be a really big video. And I have made many videos on my channel where I am showing a detailed in-depth analysis which you guys can easily check, and that is how I evaluate a business. But these were just some examples with just the summary. Okay guys, now I hope with this you guys understood my mindset, how I'm making a strategy to weather this particular economic crisis, and not just to weather this particular economic crisis, but to stay and to flourish in any economy, regardless of which type of economy you will be in. These businesses will flourish because they are fundamentally strong. These businesses will stay, will survive until and unless the fundamentals go wrong drastically, which I don't think. But yes, anything can happen. But that's why, of course, I'm evaluating these businesses or my portfolio from time to time as a long-term value investor as well. Like I said, I'm not just a pure value investor. I'm also investing in growth stocks, and that's why I wanted to show you guys how my growth stocks portfolio is performing, which is quite bad to be honest. But I want to be transparent and wanted to show you that there is still one portfolio of mine which is doing pretty great because of the same principles what I have discussed in this video, for picking up such value stocks with good dividends, who are generating good amount of free cash flow and who have been surviving since ages. Yeah, that's the reason why that particular portfolio is doing pretty good for me and the other portfolios are not doing so great. But like I said guys, these businesses, these stocks, okay, might not be able to give you 200-300% return per year like other growth stocks, but these businesses will eventually not let you down in such economic times when the same businesses who are giving you 200-300% return are crashing with the same momentum. Okay, so anyways, now let me show you guys how my portfolio is performing. I will not go on all the stocks, I will just give you the numbers and not to make this video quite lengthy. So now let's jump in. Okay guys, so this is my first portfolio. So this is a German broker for the non-German citizens, and the name of the broker is Scalable Capital for those who are not aware about this broker. And as you can see, this is my portfolio worth, and yeah, this also allows us to trade crypto, and these are for long-term retirement plans from this broker. And as you can see, if I see from the time I have started investing, it's down by 939. Okay, not so much, by let's say 8 to 10%, but this is a performance. So this portfolio is, I have designed for growth, some value stocks, and mostly ETFs. Yeah, and as you can see, my ETFs are also not doing that great. So in this particular time, and this portfolio, there are some companies which are doing good, yeah, in this portfolio, but as you can see, more there are many greens, yeah, but some of the businesses are not doing that great, and in total overall my portfolio is down by 10%. Yeah, now let's see my other portfolio. So as you can see, this is my another portfolio. This is mostly my growth portfolio. Here I have a lot of penny stocks, and this is another broker which is called Trading 212. It's a UK based broker, and this particular portfolio has many of my let's say my penny stocks and my swing trades and day trades and my growth stocks. Yeah, so this is also down by 20%. It's a huge amount. Yeah, and then that's my third portfolio for the stock market. This is nothing related to crypto. This is my third portfolio, which is in Volksbank. It's a bank in Germany, and the worth is 38,000 euros, and I'm also down by 15% here. This is also a combination of some value stocks and some growth stocks, but since growth stocks are going down heavily, I'm like 20-30% down on my growth stocks. That's why the total worth is also declining, and this is the free amount which is left for trading. But I have to pay off my property tax because I recently bought another property and I have to pay around 8,000 from here, and then the 6,000 which will be left over, I am saving that money in case the Fed's decision is much worse than what they anticipated and what the investors are anticipating, because like I said, uncertainty is bad for the market, and that could really make the market in a worse situation, and that is what I'm waiting for. I hope that you guys don't misunderstand this statement that I am hoping for market to crash. No, I'm no one to hope for anything. I'm just hoping that you guys are ready in case if there's a market crash, because I am getting ready for that. So like you saw, And like you see, I have also saved up some cash to just prepare myself in case the crash happens. And guys, like I have said before as well, that if it crashes by 50-60%, I wouldn't be surprised. And like today, the Fed also mentioned that if they would have to increase the interest rates higher than expected, then they will. This was today's statement. Anyways, I will discuss this in another video again, but that's why I'm preparing myself. So always be prepared for the worst case scenario. Anyways, now moving on to that particular portfolio, which is doing quite good. Okay guys, so now we are back on trading 212, and this is my journal portfolio like I have mentioned before a few minutes ago. And now going on to the pies, and here we are on my magical portfolio. It's not a really good return. I mean, it's not the best return, 8.34%. I have been on 200-300% returns as well, but like I said guys, that is not consistent and that is not realistic. Okay, it was realistic but I'm saying that that is not going to stay forever. Yeah, it's temporary, but this can stay forever. Yeah, even in such economic times, like I said, when the market is falling consecutively since 1 week, yeah, I am still up by 8.34%, and this is my dividend portfolio. Yeah, so I have around 46 holdings here, and I don't want to go through all the stocks because that would take a lot of time, but I'm up by 8.34% here. And not just this yield guys, I will be collecting dividends as well. So I have gained around 41 euros. This is the return. This is the yield on the stock price. Yeah, on the value of the stock, on the value of the business. But that business, apart from this, is also giving me dividends. So this is just the return on my investment for that particular business. But on top of this, I have an annual yield return on dividends as well. So actually, if I calculate the total return with this plus the dividends, my annual return until now, or for now at this particular moment for those businesses, will be around 12 to 15%, and which is what I want. Yeah, so if I take S&P 500, I am actually beating S&P 500 right now. So this is what I wanted to let you guys know, that despite of economy, what type of economy we are in, there are businesses which can really do well. Yeah, and this is for 46 businesses, 46 companies. So just imagine how all the companies in this might be doing. Yeah, when in 46 holdings I have an average return of 8.32%. So this is what I wanted to show you guys, and this is what I wanted to tell you, that this is what I am doing and this is my strategy. These are my picks. And also I would like to give a huge shout out to my Patreons family, because they are the only sole reason why I made this particular portfolio for dividends. And I researched all the companies, all the businesses, how they are doing, what is the payout ratio depending upon the cash flow, how much dividend they are paying. And guys, one more thing, that in this particular pie of mine, and guys, also I would like to give a huge shout out to my Patreons, amazing Patreons family, because they are the only reason why I made this particular dividend portfolio. And without them, I wouldn't have researched all these companies. And by the way, these holdings consist of those companies which are also dividend aristocrats, not just dividend aristocrats, but also dividend champions, dividend challengers. Yeah, so I have researched and I have made a mixed portfolio of all high return to consistent return dividend paying companies and dividend paying businesses. But all of these businesses are a positive cash flow businesses, and they have a decent free cash flow payout ratios, which is not that risky. Some are a bit risky, yes, but of course I'm evaluating those businesses and I'm changing this pie from time to time as well. So this is all what I wanted to show you guys, and I hope you guys like this video and you understood my mindset. I can be wrong guys, of course I can be wrong. I'm not God, or I'm not just some superhuman investor, but I want to try. I want to try to save myself. I want to save money and put into some businesses which are also for long term, and this is what I'm trying to do. So I'm just trying, and I hope you guys like this video. And if you appreciate this video and if you appreciate the work, then please subscribe to the channel and please hit that like button. And if you guys are interested in becoming and entering the Patreons community, then feel free to come and join our family. The link will be in the description down below. And that's all guys. I don't want to stress this video too long. I will see you in the next one. So that's it, guys. That's all for today. This was the second part of the video, and I hope you guys liked it. If you have any questions, don't hesitate to use the comment section down below. And if you guys want to be a part of my Patreon's family, then you are most welcome. You will find the link in the description down below. And apart from that, if you guys have any questions, don't hesitate to ask me. I have my personal group with my loyal members, and you can be a part of that group as well. So apart from that, stay safe, stay healthy, and I'll see you in the next one. Until then, ciao.